This company rewired cities, but still couldn't print profits. Uber changed transportation forever. Millions of people use it every day. But there's one problem. Uber is still not profitable. Before Uber, getting a ride in a big city was a gamble. You might wait for minutes, or an hour, or not get a ride at all. Then, Uber put a magic button in an app. You know the driver's name. You know the car model. You know the price before you even get in. It felt like a superpower. Suddenly, the city felt smaller, more accessible. For work, for late nights, for the airport, the app became part of daily life. The company grew at a blinding speed, from one city to hundreds across the globe. Silicon Valley's power to disrupt became a line of code come alive. For a long time, the story was one of explosive success. Millions of riders, millions of drivers, billions of trips. A black and white promise. Clean, reliable, modern. Investors poured in, betting Scale would unlock massive profits. It felt inevitable, unstoppable, the perfect business. But behind the slick app and the billions of revenue, a different story. The magic trick came with an enormous, almost invisible cost. For all its size, power, and technology, Uber wasn't making money. It was losing it by the truckload. Uber's strategy from the beginning was pure, unfiltered aggression. It wasn't content to grow slowly. It wanted to conquer the world, yesterday. Enter a new city. Flood the market with subsidized rides. Recruit a massive army of drivers. Crush competitors. Win fast. 1 month, Paris. Next, Sydney, then Johannesburg, then Mexico City. Each new pin, a victory. Launch masters deployed to navigate local quirks. Fast. Not just geography, new services. If it can move people, why not food? Uber Eats was born. Sign up restaurants, recruit couriers, deliver to doors. Then, Uber Freight. Loads meet trucks, even bikes and scooters. Investors loved the story. Endless growth. Belief. Hit scale, flip the switch, profit. Near monopoly, set prices, reap rewards. But the rocket burned enormous fuel. Marketing to win riders and drivers, local hires, complex rules, operate at a loss to undercut incumbents. Massive investments in tech, marketing, operations, billions poured into growth. Faster flight, more cash burn, raise to spend, spend to raise, and the bill kept growing. Here is the shock line. For most of its history, for every dollar earned, more than $1 was spent. Imagine selling lemonade for $1 when lemons, sugar, and the cup cost $1.20. You sell more and get poorer with every sale. That was Uber's core problem for a long time. Billions in revenue, costs growing just as fast, often faster, losses in the billions. In 2019 alone, over $8.5 billion. Not one leak, dozens. Driver payments, bonuses, rider discounts, promotions, massive staff, expensive tech, fierce legal battles, and rivals using the same playbook. A war on multiple fronts, everyone expensive. Outside, one of the world's most successful brands. Inside, a struggle for survival. It challenged what success means in tech. Great idea. Popular product, rapid growth. Still not enough. The app could summon cars, not profits. Was the model flawed? Start with the biggest cost. Drivers, raise take rate, drivers quit. Lower it, overhead isn't covered. A delicate balance. Incentives fill supply gaps, but drain margins. Uber spent billions to get drivers behind the wheel, and billions to get you in the back seat. Growth wasn't organic, it was heavily subsidized. Refer a friend, ride for free. Strategic, not generosity. Cheaper than taxis, often cheaper than parking, and sometimes even public transit. In new markets, Uber intentionally lost money per trip to starve competition. Make Uber the default. Then reduce promos, raise prices, eventually profit. But customers habituate to low prices. Pull back too fast, trips drop, rivals lure them away. Keep discounts, bleed cash. Remove them, lose share, a pricing trap. For years, your fare wasn't the true cost. Investors paid the difference. Food delivery exploded. Convenience for millions. Lifeline for restaurants. Restaurant, courier, customer. Razor-thin margins. Little left for Uber. On many small tickets, $1 or $2. Sometimes negative. Unit economics lean on volume and subscriptions. Advertising, now a 1.5B run rate, helps offset thin delivery margins. But high volume, low margin means relentless cost control. Regulation and legal fights, constant, global, expensive. If drivers become employees, minimum wage, overtime, benefits, every ride gets costlier. Thousands to build, run, and innovate the platform. Real-time maps, payments, support, complex and costly. Self-driving, billions invested, then sold. The near-term fix to driver costs wasn't ready. Added up, drivers, discounts, delivery, regulation, tech. The cost stack explains the losses and the fragile path to profit. Pursuing profit has real consequences for drivers, riders, and investors. Drivers face rising gas and maintenance costs and algorithmic pay they can't control. Sudden changes and the risk of deactivation fuel frustration and protests. Riders feel it too. Fewer promos, higher averages, more frequent surges. Recent profitability came from more rational pricing. In 2025, free cash flow hit $10 billion. But quarterly net income swung, only $296 million in Q4. Soft profit guidance sent the stock lower after a strong 2025 rally. Keep drivers with pay and incentives. Keep riders with price and service. Deliver profits to investors. Raise prices, risk churn. Cut driver pay, risk shortages. One misstep ripples through the ecosystem. So can Uber ever become truly profitable and stay that way? The story of Uber carries a sharp lesson. For a decade, the mantra was growth at all costs. Scale is not a magic wand. Millions of users don't guarantee profit. Growth without a sustainable path is a fast burn. Uber shifted from blitz to discipline. It sold cash burn projects and exited unwinnable markets. It focused on unit economics, profit per ride, per delivery. It built higher margin streams like advertising. By 2024 and 2025, Uber delivered profitable years and consistent GAAP profits while growing trips and users. Proof the model isn't doomed, but as competition normalizes, monetizing incremental growth gets harder. The question shifts: can Uber sustain and compound its profitability? Innovate, without sliding back into undisciplined spending. The final verdict isn't written. A brilliant idea isn't a brilliant business. A business must make money. Ambition must be balanced with discipline. The ride to the top is exhilarating, but lasting enterprises make the journey pay for itself. Without that, even the biggest rocket ship runs out of fuel.